How's it going, everyone? RoyalFlush here. Welcome to Meter Management, not financial advice. Remember, any of the information from this video is not advice to buy, hold, or sell any stocks or crypto. Don't fall for any of the spam in the comments. Take some good notes. Let's have some fun. Alright, so today I want to cover one of my preferred ways of trading credit spreads. They're specifically range bound, and they are similar to buying calls and buying puts, but there is more cushions and more safety in utilizing them because of how you open them and actually how you close them and managing them. Similar to buying calls and puts, but whereas those are, you make your profits really quickly or you can lose them really quickly, you can use the time on the expiration to your advantage. Easy profit off of credit spreads are due to the stock's movement. Much like any options trade, it's while you're not actually holding the stock, you're actually playing the stock's movement. And in order to help demonstrate stock's movement, I'm going to show you some fundamentals in Tekken. So let's get right into the Tekken. Alright, so Tekken 7. Fighting game that's been out since 2016, yeah. It's been holding up pretty well the last few years. And so I've already picked my characters. I'm going to use Jin and Kazuya, Kazuya. And well, the stage you pick in this game is very important because there are some wall-less stages, and much like any fighting game, your objective is to knock your opponent out. But Tekken has taught me some very important things that can translate to, well, stocks, which is what we'll get to. But first, we'll pick a stage with walls, specifically walls. This is my preferred stage, Violet system. Alright, so at the high level, Tekken is a very movement-based heavy game. While it is a 3D fighting game, you are still on one side versus your opponent who's on the other side of the stage. So it does have some things in common with 2D fighting games, but with Tekken, there's some very specific fundamentals that you have to understand. There's poking, movement, and punishing. First thing I guess people into Tekken are these long combos. So utilizing this, and then eventually taking things to the wall. So as you see there, I got a pretty solid wall combo using the wall as well, and I get to continue my pressure here. So in Tekken, while combos are really cool to look at, almost all launchers in this game are very punishable. So this move right here, this move right here, this move right here, this move right here, they're all punishable in some degree. So the universal one with Kazuya would be 1-1-2 punish. So he would just do, I would block that and do 1-1-2. Okay, so that was a punish. So with Tekken, since, you know, on top of being able to, you know, take your opponent's life down, the safer way to really play the game is just to understand your pokes. There's not as much risk involved with using them, but they are a very important part to just understanding how to deal damage. Whether it's, you know, not as much, but you're still dealing damage, you're still, you know, gaining something out of it. You're keeping yourself safe, getting knockdowns, and eventually you'll be able to just kind of get a better feel for your character and your opponent. So that's generally the gist of Tekken. But the reason why walls are so important is because once you get the wall, not only do you get combo damage, you also get added pressure afterwards. So the better you can take your opponent to the wall, the more you're at advantage and therefore doing more damage. So, like I said before, with Tekken, since it's very movement based, and while you are the one moving your character, it's a different story when we're dealing with stocks here. When you're dealing with stocks, typically it's you versus the stock's movement itself. And so in order to be a good trader or even an investor, you want to be able to understand the stocks that you're playing and how they move. So whereas Tekken, it's a very movement-based heavy game, trading the stock market is also very much a movement-based heavy game in a ways. So let's go ahead and look at some examples I've got set up for understanding credit spreads and such. So I have here my Robinhood account, and As you can see, the stock market's been taking kind of a beating lately. But the reason why I trade credit spreads is because it works better with my normal work schedule and also my time. With credit spreads, you still have to manage a trade, and also you technically don't even need to own the stocks you're playing. You could technically play the stock's movement entirely without even holding a single share. And so let's first start with how to construct a credit spread. You can do this on literally any ticker that has options on it. So we'll go to SPY. SPY is really usually a good stock to play it on. And before you could even perform these, you should actually, before you can even perform these, you need to have advanced tier options available. So on top of being able to trade options, it would allow you to combine options. So technically, with credit spreads, it allows you to sell options without actually having to own it, because what you combine is the act of selling an option, and then you buy an option to act as to act as the 100 shares you're controlling. So let's say we want the stock to go down a bit more from where it's currently at 361, and let's say we'll even buy an in the money put. Okay, so you can see on the profit and loss chart here. Let's make sure I see it. All right, so you can see on the profit and loss chart here that this red zone is out of the money and the green zone's in the money. So the further the stock goes down in price, your option would gain value. But the scary thing about this though is it will literally move in real time, and so that would move with the stock movement itself. And when you're buying calls and puts, it can be very profitable, but you could also incur heavy losses if you're not careful about it. So as a trader, you want to be able to understand the type of play you want. Are you bullish on a stock or are you bearish on the stock? Let's say if you want to buy a call option, same deal. Buying this call option right here is quite a bit. It's $429. Let's say you don't have that much money, considering you're using a small amount of collateral in your trading account. So let's say you are actually bullish on SPY, but you don't have as much money to go. So we will start with actually creating a put credit spread. Now don't let the name confuse you. Even though it has put in the name, this is actually the bullish form of a credit spread. So you choose the amount you're willing to sell the put at, and then secondarily you switch over to buy, and then what you see here will change what you see on the profit and loss chart. So as you can see, there's still a green zone and a red zone, and what's determined here is the difference between your strike prices between the put and the buy will determine how much you're credited, but also how much you need to put up as collateral. So you see here the limit price. This will determine the credit. And typically, if you're writing these up, you typically have to choose the price that's a little bit less, so that way you can guarantee that the option gets written up and filled. So you would need, let's see how much collateral you would need to actually write this. So you need a collateral of $100 to write this up. It would be collateral, and you'd get credited 65. So in reality though, you would only need about, let's go back. In reality, you would only need the amount of collateral minus the credit. Yeah, this is a put credit spread. This is the bullish version of this. But what I actually have on SPY right now is, let's go ahead and take a look at what I actually have on SPY. I'm actually betting on SPY coming down further from where it is today. I actually wrote this one up today. This is how you create the bearish version of it. This is called a call credit spread. So you sell a call and then you buy a call above it. Depending on how much you want to get credited, that's what will determine. So this was the price at closing. it's either this thing by Monday. This is for Monday expiration. It will either expire with $50 profitable or down $49 profits. So if you're buying really close to the money and also closer to expiration, you can get quite a bit, a decent amount of credit, but also when you're on expiration, it'll either be worthless or with worth. You want to close these things out when they are any sort of profitable. But on top of that, you want to understand why you're writing these things up. Are you bullish or are you bearish on the market? So always understand these things. Other trades that I have using credit spreads. I'll go ahead and go back to my portfolio and go to Starbucks. So that was an example using short-term credit spreads. Here's one that's going to be out of the money, but let's go ahead and look at my Webull charts real quick. So on Webull, I charted some stuff on Starbucks the other night, and I saw with the help of a friend that on the weekly chart, it is actually getting pretty close to having a death cross, and that's when the simple moving averages, with the strongest one, with the 200 moving average, touches a weaker moving average above the general moving area of the stock itself. So as you can see here, the 200 is ready to touch this 50 MA. So that in itself would be a death cross. That means it's expected to have some big downward moves. So that's typically how you would use your charts in some way. You can see there's a rising wedge there. So that actually means that while the price of it is actually rising in the short term, that does indicate that it might drop in the near future. Okay, so let's go ahead and go back to Starbucks on Robinhood. So right now I have here 81 and 86 credit spread, call credit spread. So let's go ahead and look at the options on Starbucks. So I have the one I have actually for a November 4th expiration. That's actually the day right after its earnings. So my idea with this one is to have Starbucks fall anywhere between now and that date. So I'll construct this one right now. So I have the sell option right there, and then the buy option right here. So again, this is the bearish version of the credit spread. This is called a call credit spread. And again, don't get confused by the name. It's actually a bearish version. You can see here on the profit and loss chart here that it's currently out of the money, but since I've anticipated a big move to the downside, that's why I have it, so that when Starbucks itself moves into lower and lower, the option value of my contract here will actually increase in value. And so now there's actually a way for you to monitor your trade, and that's actually using something called OptionStrat. We're here on OptionStrat right now, and I have the screen here showing the exact trade I have, the 86 call with the 81 sell call. So this is 86 buy call, 81 sell call, okay? And say for whatever reason, Starbucks drops all the way to $77, the share price itself. That's how much. This is just kind of like an estimate outline. There's a lot of time until this thing expires, and you can change the ranges on these things based on how you think the stock is going to move itself. So since we're only looking for like dollar changes in the stock itself, I mean really, I would only need it to get to $77. The closer we get to expiration, you can see here the values on both sides are going both up. The premium, the more the stock goes down, the more this is going up. But also, the higher the stock goes up in share price, the losses also increase. So the goal for these though is to close it with by buying the close for less than the amount that I was credited for. And so let's go back to Robinhood and determine how much I was credited for this. So on this option contract itself, I was actually credited $327. As long as I have high conviction on the price movement of this stock, this should actually decrease in value. And so what my goal is to close it for less than $327. That would be a great scenario. So anything less than 327 is my goal. So lastly, so I've shown you how to create a put credit spread and a call credit spread. Again, the put credit spread is the bullish version and the call credit spread is the bearish version. And so now what I'm going to show you is something for all you Smash fans out there who like Final Destination. Well, first we'll show you what Final Destination looks like. So if you're familiar with Smash, you might be familiar with Final Destination. And I'll just show you something about Final Destination that's going to become very commonplace for understanding the Iron Condor. Alright, so as you can see in here, typically in Smash, you want to stay on the platform, which is the stage itself. But if you take your opponent over to the side here, then they're in a danger zone. Of course, you want to keep your opponent as far out to the side of the stage as possible while staying safe on the stage itself. Think of the stage as being in the money and being off the stage as out of the money. So where you're out here, you're in danger. Might not even make it back. You want to be the one in the money and not the one out here. You're back, and you're here to look at my Iron Condor I have set on Costco. I actually have 2 of these right now. This one would be between the 475 and 495 range. So let's go ahead and look at my Webull charts to understand why I created this one. I've been tracking this stock for quite a while, and I wanted this stock to be my main stock that I create spreads on and continue to be to create my own wealth on. And so the thing about this stock that I understand is that it moves up and moves down big in either direction depending on any given day. You can see right here the big down, big up, big down, big up, big down, big up. So your objective with understanding how a stock moves is knowing how it moves and how much it moves. And so you can see here I actually have drawn many lines of indicators. I have my Fibonacci's. I have a wedge formation actually forming. It's like I believe this is a flag formation. Connecting the lower highs. So you can see it's on a downward slope, connecting that high to this high right here, which is lower, and connecting the low right here to this low right here. So it's actually getting closer and closer to breaking out of this flag formation, but all the while the lows are becoming lower and the lows are starting to catch up. But what I've noticed with Costco here is that since the highs are getting lower, it gets rejected from this trend line right here. My thesis is that every time it gets high up close to the trend line, it gets rejected. So you can see that it's drawn within a zone here. Okay, this zone is this green area. And that is why I believe that Costco, at least by next week, will stay within that range and I will be able to close out my contracts at profit. So let's go ahead and look back at my Robinhood. So what I have here is the 475 and 495 credit spread. But let me go ahead and show you how I constructed it. So this is going to be for October 14th expiration. And so we'll start with the lower legs. So what you actually are doing is combining the put credit spread, which is the bullish version, with a call credit spread, which is the bearish version. You create 4 legs, and that creates the stage for you. First, I sold this call here, the 495 for 100, and then I bought the 500 call option. So there's our call credit spread, and now we'll switch over to puts. and so I have sold the 475 one. So at the time when I wrote this, the share price was above 475. So I sold that put, and now to get the right to sell that put, I had to buy this 470 option right here. And so as you can see right there, Robinhood recognizes this as a iron condor right here. So as long as we stay within the green, we're on the stage, we're on final destination. But as long as we're in the red with Costco's share price, we gotta find our way back. But at least with the information I have on my charts, I have confidence in knowing that Costco should be able to stay within this area here on the green. And let's go see how much I was credited for it. So I was credited a total of $560, so yeah, $280 per contract. So as long as I'm able to close each of these iron condors for Costco below 280, I can say that this was a profitable trade. So I have about a week to let this play out as I have had planned. So hopefully that works out. But now let's go ahead and look at OptionStrat and see how I can manage this trade and hope to close it out at a reasonable profit. Ideally, I would want to close this anywhere in the 480s range, because it is about a $20 range, since I know that Costco moves pretty big. So right now it's at 486, 468. So that's not too far away from the targeted green zone that I wanted to stay within. You could actually look at it here on OptionStrat like this, or if you want to visualize it more as the iron condor, you can change the graph right here. You see? So this would be the current standing. This is the break-even point right here. Also break-even point right here too. 497. So there's a lot of room for this to be successful. But I've also bought I bought this one a week out. And I used iron condors for when I think the stock is going to stay within a specific range. You could also use it on when you think a stock isn't going to move very much at all, aka neutral. Because since Costco is a very expensive stock to purchase shares of, you can actually place expensive stocks like Costco, Tesla, anything that is kind of out of your price range with less amount of money, but still be profitable on it if you manage the trade well enough. And the only way, the one true way you can really understand a way a stock moves is by doing all of your charting and playing the stock via trading as much as you can, and trying to get more profitable trades than negative trades. So using spreads is actually a really good way to get exposure to a stock without sacrificing too much money as collateral. The longer the stock stays within its green zone, depending on whether you're doing a put credit spread or a call credit spread, you'll be able to close it out at a profit. And the closer you get to expiration, that's what you can see here on further to the right, that's closer to expiration. It's either becoming more and more profitable or more and more at a loss. So the goal isn't to always maximize it. You want to close it out at a percentage that you think is right for you to say that is profitable, whether that's 20% or 30% or even 50 or more. That's profitable, but always just know that the stock could swing up or down. But if you did your homework on the stock and you understand its ranges, then that will really truly help you understand how the stock behaves and how you can be profitable off of it. So let's go look at this SPY one, for example. This SPY credit spread, I was credited $44, okay? So if I lose that $44, then really I didn't really lose anything except the amount that I was willing to put up for it. But since this option is really short term, this one really is this is a true 50-50 option here. But if you give your options more time, then you can actually really have more control over how much you profit or lose off of it. But again, since SPY has many option expiration dates, You can do short-term options on spreads, or you can do longer-term ones. But if you are to do it, I recommend usually a week out. But if you're trying to swing an options movement, you can do a long-term one like I did with my Starbucks one right here. Since I'm playing this one for a few weeks, I just want it to move down within the next few weeks, and then I'll close it out at a profit. So you actually have flexibility with the time. But if you want it to be really profitable, I would recommend a week or less. And if you were to do it on something with less than a week in time, do it on something like the SPY or the Triple Qs, where it has Monday, Wednesday, Friday expiration dates. And so what I have actually been doing lately on the SPY ones are writing spreads for Monday on Friday. So today is Friday the 7th, and I actually have one open for Monday, hoping that the market dips even lower, and hoping that I can close this one at a nice profit, because I really only sacrificed $44 on this one. So this one's either going to be a hit or a miss. You can even see it right here. You can see that option right here. It's either on Monday, it's either going to be big profitable or big loss, but I didn't really sacrifice that much. So that's the gist of credit spreads. Whereas when you buy calls and buy puts, it really will require your attention to the screen and the stock's movement, because you want to be profitable on the trade. But when you're buying options, it's in real time. If you're selling credit spreads, you can actually play the stock over a matter of a day or several days. You can even day trade it if you feel like you're profitable enough on it. And the disadvantage though is that whereas it's safer for you to open, you don't get to profit as much. So if you want to profit more on something, you have to either choose one that's a little bit further out, like maybe a week, or one that's close to expiration and at the money. If you're in the money, the spreads actually require a bit more collateral to open up, but they're likely to be profitable. But if they're out of the money, so like for my example, my Starbucks one, it will require less collateral to open up. But if you understand that the stock is going to move where you have it open in the money zone, then that's where the true profits can be realized. For me personally, it works better for my work schedule, because I can't always be looking at my phone. I can only look at my phone on my breaks or my water breaks. And so I don't want to worry so much about a stock if it's gonna, eat away at my option premiums, like literally minutes away from going to 100 to 50 in a matter of seconds. That could really happen. You can actually still play on a stock's movements, whether it's up, down, or even neutral, as long as you did your homework on the stock and you can anticipate where it's going to move based on the rest of the market, any catalysts that could affect it, or you just did your homework on the stock and you're fairly confident that that's where it's going to end up by expiration. But again, you don't want to always hold these things till expiration. Make sure you close them out at a profit, because sometimes the stock's movement can scare you out of a few of these. I've actually closed some of them out that actually did end up being profitable. So playing spreads does allow you to understand the stock a lot better. And so the more you play it, hopefully the more you'll become profitable on it, which is the objective of every trader and every trade, to be more profitable than you are having losing trades. So that's it for me. Let me know what you think about spreads. Is it something that you might actually want to do? Do you prefer it to buying calls and puts? For me, I love spreads because they're a lot less stressful for me, and they allow me to play a stock similarly to how my friends are, just that works better with my time. But anyways, that's it for me. But before you get out of here, if you want to earn it, you're going to have to learn it. And in order to get what we desire, you got to jump to the fire. See ya.